Have you ever noticed how there's a really quiet, almost hidden pattern separating capital that just kind of sits there from capital that actively expands? We're exploring exactly that today in this explainer. It's essentially a study in how money behaves in the wild, how it naturally flows, and how the architecture of true financial equilibrium is ultimately designed. So let's just observe how this actually works.
It brings up a really fascinating question. What happens when doing nothing at all is actually the riskiest move you can make? We usually perceive safety in stillness, right? Just keeping things exactly as they are. But beneath the surface of that stillness, there is this subtle, everyday erosion of stored wealth. Standing still carries a very tangible, relentlessly compounding cost.
Section 1. The invisible drain, or the baseline of everyday life.
This drain operates constantly, totally in the background. A lot of us find ourselves on this endless loop, basically a financial hamster wheel, where we're working and storing capital, yet the destination just keeps moving slightly further away. Now, while official headline figures might suggest an inflation rate of, say, 2 or 3%, observing the true, rising baseline cost of a modern middle-class lifestyle reveals something else entirely. When we factor in rent, education, travel, and those quiet everyday upgrades, the cost of this baseline actually compounds at an undeniable 8 to 9%.
And this right here is what creates the trap of traditional safety. When capital is parked in a primary house, growing at maybe 6 or 7%, or sitting in fixed deposits hovering around 5%, the math gets pretty stark. Because after taxes, that capital is literally just breaking even. Stagnation sets in because the real standard of living is silently but surely outpacing the yield of those safe harbors.
Moving on to Section 2, Directing the Current and Finding the Destination of Capital.
To actually outpace that invisible drain, capital requires a highly structured destination. If we observe the architectural patterns of a truly effective portfolio, it behaves a lot like a directed river. You have this heavy, stabilizing current, about 50%, flowing steadily into broad index pools and mutual funds. Right alongside it, a much smaller, highly concentrated 15% stream is directed towards specific, high-conviction direct stocks. And then the remaining 35% forms these essential tactical counterweights. This setup creates a really crucial duality in how equity is allocated. On one side, we have passive accumulation. This is simply capturing the broad economy's slow, reliable march through index and mutual funds. Then, on the other side, we have active conviction. This is actively seeking out dominant, high-velocity market forces through direct stock investments. It's a balance that allows a portfolio to safely capture the growth of the collective market while simultaneously hunting for those massive, outsized returns. Section 3. The concentration of conviction and finding dominance.
Identifying the singular high-velocity engines requires a very specific lens. Capital just naturally gravitates toward market monopolies or duopolies where competition is visibly fading away. The core characteristics we observe are undeniable: a rich, completely sustainable river of cash flow protected by incredibly high barriers to entry. We're talking about entities that don't just participate in a given market, they practically dictate it.
And when that level of conviction is found, the expansion of wealth becomes structural. For example, take a highly concentrated bet on a major cash-rich stock exchange, which is essentially a virtual monopoly. Over a span of just 4 to 5 years, that singular engine dynamically multiplied capital by 22 times. It's wild to think about, but a tiny initial position can organically expand to totally dominate a portfolio. That is the sheer velocity of concentrated dominance.
Section 4. The shift in desire and following the capital.
At the end of the day, markets are just real-time reflections of human behavior. And right now, we are observing a massive defining economic trend: premiumization. It's this continuous upward drift in consumer preference. It's a quiet but massive migration away from just basic necessities toward exceptional, upgraded experiences. And for capital, this behavioral shift is opening up massive, incredibly long-term opportunities in the stock market.
We can see this upward drift absolutely everywhere. Basic lodging is giving way to this huge demand for high-margin hospitality. Standard commutes are being replaced by absolute surges in sunroof-equipped premium vehicles. Even standard delivery is compressing into premium 10-minute convenience. Identifying the companies that are actively driving and capturing this upgrade reveals entirely new cash-rich landscapes for long-term equity to occupy.
Section 5. The Mechanics of Equilibrium and Absorbing the Shock.
Because the reality is markets breathe. They expand beautifully, but occasionally they contract violently. And an architecture built purely for expansion will eventually fracture under that pressure. This is exactly where hidden counterweights become vital. A well-balanced system holds about 12 to 15% in non-correlated metals like gold, 10% in highly predictable debt instruments, and a buffer of tactical capital. Together, these pieces seamlessly absorb the shock of volatility. These shock absorbers actually act as two very distinct forces. Gold and debt serve as heavy anchors. They provide a stabilizing, frictionless buoyancy when equities inevitably drop. Tactical capital, meanwhile, is highly agile. It's designed to move swiftly into assets like silver during a sharp price drop or step confidently into emerging foreign markets when domestic valuations just get too overheated.
Maintaining this equilibrium is as much a behavioral exercise as it is mechanical. When volatility strikes, the system survives by systematically rebalancing, quietly moving capital from the protective anchors of gold and debt straight back into discounted equities. It relies heavily on ignoring the daily noise of the market and having the structural readiness to deploy cash directly into moments of extreme fear. Historically speaking, that is exactly how profound wealth is captured.
Section 6. A self-sustaining system, the ultimate design.
When those broad pools, the concentrated engines, and the heavy counterweights are all assembled correctly, they transition into something pretty remarkable, a self-sustaining system. Escaping that invisible drain means recognizing a fundamental truth about wealth. The true function of money is expansion. Capital isn't just for hoarding, it's the raw material used to build a mechanism that inherently grows and perpetuates itself.
The mechanics behind it are actually quite straightforward. First, we define the true baseline lifestyle cost. Second, we deliberately channel capital into both passive broad markets and active, concentrated pools. And third, we architect those vital counterweights to regularly rebalance and survive literally any weather condition. Once set in motion, it just becomes an effortless, continuous flow. Which leaves us with a rather quiet but deeply vital realization to reflect upon today. If we look closely at the flow of our own financial architecture, is the capital simply sitting and waiting, slowly eroding against that invisible drain, or is it purposely designed to expand, capture market dominance, and perfectly balance the weather? Thanks so much for joining us for this explainer.